So if USDA loans are this incredible 0% down option, why have you not seen more of your friends and family use the USDA loan to buy their first home, or really not even just their first home, but any home? Realistically, USDA loans do not work almost anywhere in California. There's very few places that you can actually make it work, and we're going to go over why. But those reasons include the guidelines for the USDA loan. Now, like most things government, the thing with the USDA loans is they haven't kept up to current market times, and that's the biggest downside. Now, just 90% of most things government, they haven't kept up with the current times, which is the reason you don't see more of these USDA loans, even being such a great loan. So at the end of this video, I'm going to talk about what USDA could do if they were to make this loan a lot more usable and actually user-friendly so people in California could use it as well as the rest of the US. Now, as we all know, USDA is backed by the government. It's 0% down. And it only works for home in rural areas, which depending on the area you're in, that rural could mean anywhere less than 10,000 people in the population for that little city. Or depending on how far it is outside of the city, it's outside of a metropolitan area, it's going to have different rules depending on each. Now, what's easy is there is a USDA eligibility map down below. You can link it, go click on it, check it out, see if the house you're looking for qualifies as USDA. And to be totally honest, when I started digging into USDA a couple years ago, I found that realistically, a lot of homes that are not directly within a city, any major city, qualify for it. So why don't we see more of these? I know for me in Sacramento, a lot of things, even places in Loomis and Penryn, Yuba City, there's a lot of places around us down in Galt that qualify for a USDA loan. Why do we not see more USDA loans? Now, the biggest issue with USDA loans is not the income limits. A lot of people qualify for it. And it's not that you have to be a first-time buyer. It's not even that you can't have a cosigner. It's the debt-to-income ratio limit on a USDA loan opposed to an FHA or conventional loan. Now, when you're looking at mortgage, you have two ratios. You have your front end and you have your back end ratio. Now, for a conventional loan, you have 50% on both. For FHA, you have about 46% on the front end and a 55% on the back end. And for USDA, you have a whopping 29% on the front and about a 41% on the back. Now, let's break it down real quick. If you make $100,000 a year, you're averaging $8,333 a month. 50% of $8,333, if you were looking at a conventional loan, is going to be about $4,110 a month. That's your max payment for all your debts. That's your credit cards, your car, and your mortgage payment. With USDA, that number drops down to 29%. So that same $100,000 income, you're going to have your monthly income is about $8,333. 29% of that is going to be $2,415 a month. That is now your max overall debt, which going from $4,100 a month to $2,400 a month is a whole lot different when you're looking at mortgage payment. Let's break down what front and back end debt to income ratio are. The front end ratio is just your mortgage payment. Now, this is going to look at your mortgage payment over your gross income. That's how you get this ratio. It's going to include anything that's involved in your mortgage. So your actual mortgage payment, your principal and interest, your taxes, your insurance, and HOAs if you have any. USDA caps this at 29%, which is pretty low. So if you made $10,000 a month, your max front end ratio for any housing would be $2,900. Now, back end ratio is your mortgage plus all your other debts. So this can include your car, your credit cards, any installments you have, personal loans. Now, USDA caps this at 41%, which is actually pretty good. That's very realistic. Now, the difference is with FHA, their front end ratio for your mortgage payment alone caps at that 46%, and conventional caps at 50%. So depending on the program you're at, a 50% cap on that front end ratio, if you have no other debt, you're allowed to qualify for the max amount of home. Versus with USDA, your mortgage payment can only be 29% no matter what. So even if you have no debt, it doesn't actually help you qualify for more of a house. Because most homes in California cost too much money. That's why USDA is not really usable anywhere in California. That 29% front end ratio absolutely kills the deal. Because most of the time you cannot find and finance a home, at least not with zero down, which is why most people think about this loan in the first place. That's going to cost you less than that 29% of your total income, especially if you make within the income limits for USDA. So I hope that answered your question on why no one uses USDA loans in California. In other states, you see them a lot more. They're a lot more normal because the home prices are not as skyrocketed as what they are here. Now, the best way I can explain this to you is every $13,000 of a home requires about $100 more of a monthly payment. Somewhere in there. That's not an exact number, but pretty close. $13,000 to $15,000 of a home is going to be about $100 more a month. So taking into account what your max debt to income ratio is, if you can go from $4,100 down to now you only have $2,400, that qualifies you for about $210,000 less of a home than you would if you were to go conventional. Now, obviously, there's the benefits of no mortgage insurance and you're going to have a slightly lower rate. So that's a give or take number. But in general, the mortgage payment, which is what you qualify for a mortgage off, changes that much. So if you make $100,000 a year and you have no other debt, the max home you could probably qualify for with USDA loan is going to be around $315,000 to $330,000. Now, thankfully, USDA income limits change depending on how many people are in your family and which county you're in. So it's possible to go up to somewhere around $400,000 to $415,000, depending on which county you're in. Some places more than that, some places a lot less. But that's the biggest reason USDA loans are not used. Now, more often than not, what I see actually used for most people in California is down payment assistance. Now, I'm not going to dig in too much today because I don't want to bore you, but I have other videos that are linked up above if you want to go look at what down payment assistance looks like. Now, these down payment assistance programs, the reason they work better is not because they're nothing out of pocket. You're still paying a closing cost or a fee to use the program, but you can get those fees covered by the sellers. Now, the benefit of using a down payment assistance program as opposed to USDA is that down payment assistance, you can still qualify for that higher home. So if you're in this area in Sacramento, you can't do USDA for more than usually around $330,000, which if you live here, you know that's not possible here. There just are no homes under that, or at least very few. Now, with down payment assistance, you could still qualify for your $400,000, $500,000, $600,000, even $700,000 house. And depending on how you structure the deal, you can come in with zero out of pocket still. So when you're looking at the difference in these two, if you're at that $100,000 a year salary or income, with USDA, you can qualify for around $330,000, whereas with FHA or conventional with down payment assistance, that same income qualifies you for up a little over $500,000. Now, as I mentioned, I said, what are the things that the government could do to make these loans more available and actually useful to us? First off, the only thing they really need to do, because the income limits have stayed updated for the most part, they're pretty good. The only real thing they need to do is update the debt to income ratio. 29% in this economy is almost impossible to find a house in for the front end ratio. The front end ratio is just your mortgage payment. Now, this is going to look at your mortgage payment over your gross income. That's how you get this ratio. It's going to include anything that's involved in your mortgage. So your actual mortgage payment, your principal and interest, your taxes, your insurance, and HOAs if you have any. USDA caps this at 29%. So if you made $10,000 a month, your max front end ratio for any housing would be $2,900. Now, for a conventional loan, you have 50% on both. For FHA, you have about 46% on the front end and a 55% on the back end. Because most homes in California cost too much money, that's why USDA is not really usable anywhere in California. That 29% front end ratio absolutely kills the deal. But if you want to see if you qualify for USDA, I'm happy to run the numbers with you and show you what will work and what you qualify for. Because most likely you'll qualify, it'll just be a different number than what you want. Now, after we have that conversation, if you want to look at down payment assistance, we'll have another conversation after that. Same application either way, and we'll get you numbers for what's going to work for you. Let me know if you got questions, and I'll see you next time.